Hey everybody, my name's Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm covering disruptive tech stocks for a broad audience of retail and institutional investors across the globe. Today we're going to talk about a company called Guardant Health. The title of this slide is The Storm Before the Storm. And we'll talk about that in a second, but I wanted to start this presentation out with a gem of wisdom from Zacks Equity Research. This is regarding Guardant's earnings report, which will be released tomorrow, May 5th. And they say that the stock might move higher if these key numbers top expectations. On the other hand, if they miss, the stock may move lower. So I'll leave you with that bit of wisdom. I think this sums up today's investor that's really focused on trying to predict the short-term price movements of a stock as opposed to looking at the quality of a business. So when we look at the behavior of Guardant stock over time, it's quite interesting. Yesterday, the stock dropped 12% for whatever reason. And that's odd because then again today, we see the stock down 3 or 4%. And it seems to be having a lot of price action going into the earnings call, which will be tomorrow at close of business. So be that as it may, what we decided to do was to take a look at the company before that earnings call happens so that we can avoid all that noise and see how they fared over 2021. So a couple interesting charts to look at here. On the left-hand side, you'll see the annual revenue growth. That's done quite well. As you can see, now that's accompanied by heavy losses. And you can see on the right-hand side here, the steady quarterly growth, and that they appear to be reining in their losses a bit. But we need to be very careful about companies that spend $1.50 to acquire $1 in revenues. Now, when we look at what Guardant's doing, and I'll put in the link to this video or in the description, links to research pieces that we've published, the one we published today, as well as the one looking at Guardant. We did several actually, as to what they do. So Guardant sells liquid biopsies, and you can read about what those are in our pieces. But this chart here shows how many they're selling and who they're selling them to. So the clinical customers, those are the end patients, are the majority of the test volume. And they also have biopharmaceutical customers. And you can see that number dropped off in 2020 because of the Rona. So we see a steady volume of increase in tests. And this is something to monitor over time. It's a metric that they put in their 10K. Now, when we look at total addressable market, the company says there's a potential test population of 700,000 patients in the United States. If we take the Medicare reimbursement number of $5,000, that would put the TAM at around $3.5 billion, but Grail puts this US opportunity at $6 billion. So that's a long way from where they're at right now. And here's a chart that shows how they've calculated that, shows how they've calculated their total TAM, which is quite large. So it's over $50 billion. And you can see here the test Guardant 360 CDX. That's their flagship test, and that's what they've been selling. In that previous slide, we saw those test numbers. That's what they've been selling. Now, we also see here a test called the Lunar 1 and the Lunar 2, and we're going to talk about those as well. The table that you see here shows the various tests that they have on offer. So the second item on this table is the Guardant 360 CDX. That's the one that they're selling loads of. And then they have this other Guardant 360 Response test that they expect will affect that $6 billion TAM, though they don't give us a lot of color as to how much that will affect the TAM. But this is a test that is a follow-on to track the response to immunotherapy and to see how cancer progresses. And at the very bottom here, this was some big news on Monday. So this Lunar 2 test, that's now called Guardant Shield. And on Monday, they said that it's being officially released now. And that was after a very extensive trial with 10,000 patients. And this test will screen for colon cancer, among other things. And that's particularly relevant to investors in Exact Sciences who would be betting on the Cologuard test from Exact, which has made them quite a bit of money. So when we look at, it was an excellent article that Barron's published, which talked about this announcement, and it said that Grail's gallery. So remember, Illumina purchased Grail, and there was all that drama around the regulators and whatnot. And I'll include a link to the article that we wrote around that. But Grail is also doing cancer blood tests, and they have a remarkably low 0.5% rate of false positives. So false positives not very good because you have a patient who thinks they have cancer when they don't. Well, Guardant's Shield, by comparison, has 8% rate of false positives. Now, Illumina is arguing that the low rate of false positives is essential to the wide acceptance of a cancer screen. But as we know, the life sciences community is going to vote with their wallet. So it all comes down what people are willing to pay. So that remains to be seen. Now, Grail, Illumina pretty much just steamrolled the regulators and went forward with the acquisition and really pissed off the European regulators in particular. So that opens the door for Guardant to sell their tests in Europe, where Grail might not be able to. But you can see here some of the information on Grail's blood test that detects over 50 different cancer types. Now, we're not going to get into the details of what these tests do or the benefits of each, but we wanted to focus on Guardant and the health of their business. So as of the end of the year, Guardant had about $1.6 billion in cash and cash equivalents. So if they're burning about $100 million a quarter, which they have been, that'll give them about 4 years. So that's a decent amount of runway, and that'll bring us to 2026. Now, in 2027, they have $1.13 billion in convertible debt that's due. Now, how this works is that the person who gave them that money can then convert that debt to shares at a strike price of $139.82. That was the original deal. Well, interestingly enough, what Guardant did is they actually hedged that. And for the cost of $90 million, they changed that strike price to $182.60 a share. Quite interesting. We haven't seen firms do that, or maybe we never noticed, but it's an interesting speculative move by Guardant, because essentially they're saying that shares of their company will be greater than $139.82 by the time we reach 2027. So the concern there was that if the person who issued that debt did that conversion, then it would dilute existing shareholders. So they've reduced the potential risk of existing shareholders being diluted. We thought that was quite interesting. Now, when we look at valuation for Guardant as the share price continues to slide, what we can do is take our simple valuation ratio, which looks at market cap and divides that by annualized revenues. So take last quarter times 4, and we've plugged that in to give Guardant Health a valuation ratio of around 12. We can compare that to some other firms. So Exact is a lot cheaper valued based on that metric, and we'll talk about maybe why that is in a second. Then you've got Illumina around 10, 10x Genomics around 10, and Invitae, which has been absolutely punished at around 3. So all this tells us is that Guardant wouldn't be considered wildly overvalued and perhaps is in line with its peers. Now, I wanted to talk a little bit about Exact Sciences, which is also hitting new lows, and it's quite interesting that they're seeing the same sort of consistent revenue growth as Guardant. And, we don't like to really focus on what ARC does, but this was kind of interesting. So if you look at ARC's Innovation ETF, that's their flagship. This is 6th in that ETF in terms of weighting right now, and it's the first position in ARC Genomics. Guardant's nowhere to be seen. And it's just what it is. It's quite interesting that they haven't taken a punt on Guardant, and we're not sure why that is. Now, when you look at what Exact Sciences is doing, they're selling these Cologuard tests. So this was their flagship product. And you take a stool sample and it will tell you whether or not you have colon cancer. And for the price of $500, you can take one of these tests. It's being recommended by Katie Couric. who it was also the front runner there for Yahoo Finance. And the old joke was that both are old and antiquated. So she's now peddling $500 stool sample tests, and these tests can detect 92% of cancers, colon cancers, and 42% of large precancerous polyps. And surprisingly high, 13% false positive. So 13% of the people taking this test are going to be worried for no good reason. So one of the interesting things about this, whilst this made the company a lot of money and continues to, there was this interesting article put out by the Gastroenterology Consultants of San Antonio that talks about how Cologuard tests are not recommended as a replacement for colonoscopy, and that's certainly not very good for Exact. But when you look at what they're doing now, screening from Cologuard is now becoming a let's say it's still a majority percentage of what they do, but you can see here on the right how they've also entered precision oncology. So I think the next thing to do that would be quite interesting is to see how Exact Sciences compares to Guardant in terms of the overlap between these two companies. So our next piece will probably go into looking at what Exact has been up to and why ARC might be so bullish on this particular firm. Well, just to conclude, temporary disappointments are great buying opportunities. So let's hope tomorrow's earnings call is an absolute disaster without any systemic risks being presented, and that shares just crumble, because that would represent a great buying opportunity. Now, when looking at the progress Guardant has been making, everything seems in line. So we went through the 10K. We like to do that at least once a year. The one thing that would be nice to see are the test numbers broken out by test type. So they've spent a ton of money on R&D and sales and marketing to get these new tests out there. We'd like to see how the progress is for these new tests, not just their flagship tests that they've been selling. So that's one metric that would be great to see. In terms of guidance for 2022, their guidance 460 to 470 million. That's a growth of 20%, 24% over 2021 at the midpoint of that guidance. So that's decent growth. We'll hope the company does what they say they'll be able to do, and we'll see what happens in tomorrow's earnings call. And if there's an opportunity to pick up shares there at a decent price, then Nanalyze Premium subscribers will receive an alert if that happens. So please go ahead and put your questions and comments in the comments section. We'll address them there. Make sure you subscribe to our channel, and thank you very much for taking the time to watch this video today.